Insurance Analytics. At the recent General Assembly of the Swiss Actuarial Association in Brunn, Switzerland, I showed several of my colleagues the credit card type definition of the actuarial profession issued jointly by the faculty and the institute. Overall, I agree with the wording. Actuaries are respected professionals whose innovative approach to making business successful is matched by a responsibility to the public interest. Actuaries identify solutions to financial problems. They manage assets and liabilities by analyzing past events, assessing the present risk involved, and modeling what could happen in the future. This will definitely facilitate life for Swiss actuaries in a country where the name actuar is still a synonym for scripturians, like the secretary of the local dart club. No doubt discussion will arise over the front-side running definition, making financial sense of the future, and the absence of the explicit use of the term insurance in the detailed backside one. The latter is perhaps a pity, as recent events on worldwide stock markets have shown. Several, through Fusionitis and megamenergemania, grown all finance or bank assurance concern are getting sale and declare to the public that again small is beautiful and that insurance concern should return to their core business, which is insurance. Stock market rallies are not always around to catch too high combined ratios or pay for opportunistic warranties. No doubt current events, including also the accounting scandals, will have an input on our profession. It is my hope and indeed firm belief that actuaries who are true to their prudent methodologies will come out the better. This brings me to the title of my editorial, Insurance Analytic. This terminology was coined by Till Goldman, one of the spiritual fathers of the value at risk concept, after I gave a talk with the title Actuarial versus Financial Pricing of Insurance on the occasion of a risk management in insurance firm workshop at the Wharton School on 16 May 1996. In this talk, I tried to convince risk managers from the banking world that there is a lot to be learned from standard actuarial methodology. Since that meeting, I have become more and more convinced of this fact and have developed a course under the same title as part of our Master of Advanced Studies in Finance program at the Swiss Federal Institute of Technology or ETH and the University of Zurich. Before I dwell a bit more upon what is behind the name Insurance Analytics, I first would like to say that I was pleased to see that David Wilkie, in his recent guest editorial, also touched upon this potential transfer of knowledge from the actuarial to the banking world. For too long, it seemed that the intellectual flow has been going solely in the other direction. The latter was very much present in the risk management era around Basel I and VAR. We have all seen in some form or other the provocative statement, any life insurance policy equals a package of options. Whereas this may be true from a mathematical mapping point of view, I would be very cautious hence to conclude we therefore can price and hedge this policy with standard tools from finance. Before one embarks on the latter, it would be wise to have a much more careful look at the condition under which these standard tools were developed. One then quickly runs into issues of incompleteness, a point also raised by David Wilkie. Incompleteness concerns an area of mathematical finance where the appropriate tools lay in actuaries' drawers for many years. It is no coincidence that one of the standard pricing and hedging approaches to credit risk is referred to as the actuarial method. Similarly, one could overall claim that any reinsurance contract is just a combination of standard options, albeit written on an insurance loss index rather than on a financial one. An interesting development concerns the new kid on the risk management block, operational risk. This is the risk of loss resulting from inadequate or failed internal process, people and system, or from external event. All the operational loss data I have seen are very much like non-life insurance loss data of the large claim kind. Hence, methods from standard courses on insurance risk theory like total claim estimation, Euler-Penge recursion, Rune reserving, extreme value theory, IBNR, and related technique ought to be relevant. Similar to the catastrophe insurance industry, banks are admittedly very cautiously discussing the possibilities of data pooling for certain operational risk type in order to get out overall loss curve and then calibrate this on their own loss data, indeed a deja vu situation for most actuaries. All this is conditional on the fact that regulators indeed want to press ahead with a detailed quantitative analysis of such losses. I personally have serious reservation against such a development. On the more technical mathematical side of market risk modeling, many of the recent models that move away from Brownian motion at Gaussian jump component look at Levi processes, pure jump process, and for actuaries well-known use doubly stochastic Poisson procedure. The latter typically run in business, also called operational time. Changing the clock as a function of market intensity was already put into the actuary's toolkit in the 1930s by Harold Crane. No doubt credibility models will find their way, under that what name, in the financial risk manager's vocabulary. In a recent talk I attended, the speaker with a more finance-related background informed his audience of a patent he was taking out on a new way for pricing general derivatives in essentially incomplete market. The product covered included real option, insurance and energy derivative. Actuaries attending the talk brought to the speaker's attention that his approach in part was very much akin to actuarial pricing based on operational time and credibility. A final important example concerned the blind belief within the banking industry that quantile-based risk measures are the holy grail of quantitative risk management. Every actuary knows that the residual risk beyond the quantile is the amount that matters as any reinsurer, and also that normal-based models must, through their unrealistically thin tails, the important point. Actuaries have looked for some time now at risk measures suitable for multi-period, long horizon, and adequate for long-tailed loss distribution. A huge actuarial literature is available. I could have added numerous other examples. The point I want to make is that the current development in financial and insurance regulation will no doubt intensify the exchange of ideas between actuaries and finance experts. If this is done on an equal intellectual footing, then both sides and the financial system as a whole will benefit. This intellectual equality one cannot achieve by decree. It has to be earned and fought for. This leads me to a key question which one often, even explicitly then implicitly, hears throughout the media. Where were you actuaries during the bull period? Why you didn't warn us more forcefully? And it is not just the problem currently prevalent in the banking and accounting world. Worldwide and for some time now, life insurance companies, for instance, have suffered and many are still suffering. The bank assurance concept seemed to have ground to a halt. Where was our responsibility to the public interest or our innovative approach to making business successful? Thank you.